am Professor Anuradha Jain. Will be talking to you about tools of macroeconomics today, and I am a professor of economics at Vivekananda Institute of Professional Studies, Delhi. Macroeconomic policy is concerned with the operation of the economy as a whole. It is the study of the aggregates, and in broad terms, the goal of macroeconomic policy is to provide a stable economic environment that is conducive to fostering strong and sustainable economic growth, on which the creation of jobs, wealth and improved living standards depends. The key pillars of macroeconomic policy are fiscal policy, monetary policy and exchange rate policy or stabilizing policy. These brief outlines the nature of each of these policy instruments and the different ways they can help promote stable and sustainable growth, because the main objective of any policy is to achieve growth rate, high growth rate, to reduce unemployment, to reduce inequality of income, etc. Tools of macroeconomics are used to counter when unemployment is rising and GDP is falling, productivity growth has declined, country has a balance of payment crisis or large trade deficits or attack on currency. Governments have certain instruments that they can use to affect macroeconomic activity. A policy instrument is an economic variable under the control of government that can affect one or more of the macroeconomic goals. Now, by changing monetary, fiscal and other policies, government can avoid the worst excess of the business cycle or increase the growth rate of potential output. And the two major instruments of macroeconomic policy are fiscal policy and monetary policy. Now, first we will discuss about fiscal policy. Fiscal policy is the policy of the government and it operates through changes in the level and consumption of government spending, the level and types of taxes imposed and the level and form of government borrowings. Government can directly influence economic activity through recurrent and capital expenditure and indirectly through the effects on the spending, taxes and transfer payments on private consumption, investment and net exports. The fiscal policy refers to the government expenditure and taxation policy in the economy, and the taxes collected by the government from various sources like income tax, corporate tax, excise duties, etc. are utilized to fund expenditure on various activities like infrastructure building, education, health, industry, agriculture, etc. By increasing government expenditure or reducing taxes, the government can increase the aggregate demand in the economy and pull it out from the recession, and this is called expansionary fiscal policy, because expansionary fiscal policy will lead to increase in the money supply in the economy, and you know that if money supply increases, then the purchasing power of the public will increase, they will demand more, and this is known as expansionary policy or expansionary fiscal policy. Similarly, when there are inflationary tendencies in the economy, if prices are increasing, prices are going high, then government may cut down its expenditure in the economy or increase taxation in order to stabilize the economy, because at that time to control inflation, the aggregate demand has to go down and therefore they need to decrease the money supply in the economy, and this type of policy is known as contractionary fiscal policy. So, fiscal policy therefore is the use of government spending, taxation and transfer payments to influence aggregate demand and therefore the real GDP. If you imagine the government as the doctor carrying the medical kit, then these three things are in the toolkit of the government, that is government spending, taxes and transfer payments. Now, let us briefly look at some examples of each one of these fiscal policy tools. Now, first tool is government spending, government expenditure. Government expenditure includes the purchase of goods and services, for example, fleet of new cars for government employees or missiles for national defense. Government spending is a fiscal policy tool because it has power to raise or lower the real GDP. And that major component of government spending or expenditure is the expenditure on the infrastructure. So, by adjusting government spending, the government can influence the economic output. Like as we discussed, for example, now if they want to go for expansionary policy, then government may increase their spending. And if government expenditure increases, people will get employment, people will get income, money supply in the economy will increase, their purchasing power will increase, they will demand more goods and services, production will increase, and that will lead to increase in the national income of the country. That may also lead to increase in the growth rate of the economy. Now, in addition to the primary effect of the government spending on the economy, this spending multiplies through the economy as it affects businesses who sell the goods and services bought by the government, and consumers then go on to spend the pay hikes and they earn from those businesses, stimulating real GDP even more. Another tool in the hands of the fiscal policy or the instruments in the hands of the fiscal policy is the taxes. Now, let us talk about taxes. Taxes are a fiscal policy tool because changes in the tax rate affect the average consumer's income, and changes in the consumption leads to the changes in the real GDP. Now, for example, if government increases the direct tax rate, now increase in the direct tax rate will lead to fall in the disposable income of the consumers. Now, if disposable income goes down, they are left with less income to which they can spend in the economy, and therefore their demand goes down, and that will negatively affect to the real GDP, or because that may lead to fall in aggregate demand and investment or production in the economy. So, by adjusting taxes, the government can influence economic output. Taxes can be changed in several ways. Firstly, like marginal tax rates can be raised or lowered. Secondly, they can be eliminated entirely, or the tax rules can be modified. It depends upon the requirement and needs of the economy at that moment. Another instrument in the hands of the government is the transfer payments. Now, we have talked about government spending, then we talked about taxes, and now let us see what transfer payment. Transfer payments include things like social security, welfare, or unemployment checks, unemployment allowances, pensions given by the government. Now, these allowances go out all over the country on a monthly basis or maybe annually basis and serve as the income for millions of people in the economy. Transfer payments are fiscal policy tools in the same way that taxes, because change in transfer payments leads to change in the consumer's income, and when consumers spend more of their income, this influences economic output. Like that during COVID time or during this crisis that we are facing, government announces many types of allowances that are given to the senior citizens or affected people, those who are the victims of the COVID. And because of this, when money supply increases, when people get income, they will demand goods, they will buy more goods, and that will motivate the investors to invest and produce more. So, this is how transfer payments also affects national income or also influence the economic output, aggregate output in the economy. So, fiscal policy denotes the use of taxes and government expenditure. Government expenditure come in two distinct forms. First, there are government purchases. This comprises spending on goods and services, purchase of tanks, construction of roads, salaries for people, and so on and so forth. And in addition, there are government transfer payments which boost the income of targeted groups like such as elderly or unemployed people. Now, from the macroeconomic perspective, government expenditure also affect the overall level of spending in the economy and thereby influence the level of GDP. The other part of fiscal policy like taxation affects the overall economy in two ways. Tax affects people's income by leaving household with more or less disposable income, as I told you. Taxes tend to affect the amount of people spending on goods and services as well as the amount of private savings. Private consumption and savings have important effect on investment and output in the short run and long run. Now, in addition, taxes affect the prices of goods and factors of production and thereby affects the incentives and behavior of the producer as well. Now, second instrument in the hands of the macroeconomy is the monetary policy. Monetary policy refers to the credit control measures adopted by the central bank of a country. Now, in case of Indian economy, RBI is the sole monetary authority which decides the supply of money in the economy. The Chakrabarti Committee has emphasized that price stability, growth, equity, social justice, promoting and nurturing the new monetary and financial institution have been important objectives of monetary policy in India. Now, monetary policy is an economic policy that manages the size and growth rate of the money supply in the economy. So, it is a powerful tool to regulate macroeconomic variables such as inflation, unemployment, growth, production, national income, etc. And these policies are implemented through different tools, including the adjustment of interest rate, purchase or sale of government securities and changing the amount of cash circulating in the economy. The central bank or a similar regulatory organization is responsible for formulating these policies. So, the primary objective of monetary policy are the management of inflation or unemployment and maintenance of currency exchange rate in the economy. Now, to come back to again the tools of monetary policy or instruments of monetary policy, there are various tools which RBI can use to control the money supply in the economy. Now, first, if we talk about bank rate policy, the bank rate is the minimum lending rate of the central bank at which it rediscount first class bills of exchange and government securities held by the commercial bank, or you can say that is the rate at which the central bank provides loans to the commercial bank. Now, when the central bank finds that inflation has been increasing continuously, it raises the bank rate, because if RBI increases the bank rate, the borrowing from the central bank becomes costly and commercial bank borrow less money from it, because if they have to pay more, then obviously they will have to charge more, and therefore in return they will have to increase the interest rate. So, the commercial banks in reaction raises their lending rates to the business community, that is interest rate, and borrowers who further borrows less from the commercial bank. So, there is contraction of credit and prices are checked from rising further. On the contrary, when prices are depressed, the central bank may again think of lowering the bank rate in future. So, at the time of inflation, central bank uses the contractionary monetary policy, because there is a need to control the prices of the commodities in the market. So, it is cheap to borrow from the central bank on the part of commercial banks when central bank lowers the bank rate, and the latter also lower their lending rates if the objective is for the expansionary monetary policy, they want to increase the money supply in the economy. So, businessmen are encouraged to borrow more, investment is encouraged and followed by rise in output, employment, income and demand, and the downward movement of prices is checked. Another tool with the monetary policy is change reserve requirement. Central bank usually set up the minimum amount of reserves that must be held by the commercial bank. There are two types of reserve requirements, CRR and SLR, cash reserve ratio and statutory liquidity ratio. So, if by changing the required amount, the central bank can influence the money supply in the economy. Like if RBI increases the SLR rate, statutory liquidity ratio rate, then commercial bank will have to keep more money with them as a statutory reserve, and they can lend less amount of money in the economy, and which is known as the contractionary steps of the RBI to control money supply in the economy. So, if monetary authorities increases the required reserve amount, commercial banks finds less money available to lend to their clients, and thus money supply decreases in the economy. And when money supply decreases, the purchasing power of the people goes down, their demand will go down, the aggregate demand goes down, and that will help in controlling the inflation. But sometimes, when they try to control inflation, the other problem arises, and that may lead to increase in unemployment because the investment, the production goes down. So, it is the priority that we have to see that whether the control of inflation is important by contractionary policy, or the priority is to increase the growth rate of the economy by following the expansionary monetary policy. So, it depends like what is the priority at that time, and which step they will take, whether they will go for contractionary policy or they will go for expansionary policy. So, commercial banks cannot use the reserves to make loan or fund investments into the new business, okay, because since it constitutes a lost opportunity for the commercial bank, central bank pay them interest on the reserves which they are keeping with the central bank in terms of cash reserve ratio, and the interest that they pay is known as interest on reserve, that is IOR or IORR, which is known as interest on required reserve, because it's a mandatory requirement for all the commercial bank to maintain that CRR with the central bank. Next instrument in the hands of the monetary policy is the open market operation. So, the central bank buys or sell on behalf of the government, okay, securities to the government and non-banking public, that is the open market. So, therefore, it is known as open market operations, and the best example of these securities are the treasury bills. When the central bank sells securities, it reduces the supply of money or supply of reserves, and when it buys back securities by redeeming them, it increases the supply of reserves to the deposit money bank, thus affecting the money supply. So, I would like to add here that this is the tool which directly affect money supply in the economy, because when RBI sells the securities, direct people will deposit money there, people will pay money there, and they will buy the securities. So, it has a direct impact. Otherwise, when you see the reserves or when you see the bank rate, so it has a chain over there, because in between interest rate changes, and that may affect the money supply, may not affect the money supply, but open market operation is the instrument wherein it has a direct impact on the money supply in the economy. And when RBI redeems this securities, so they pay back money to the people, and money supply increases in the economy by leaving the direct impact on the money supply. But how does such a minor thing as the money supply can have such a large impact on macroeconomic activity? Okay, so by changing the money supply, the Reserve Bank can influence many financial and economic variables, okay, such as interest rate, prices, foreign exchange rate, aggregate demand, aggregate supply. So, money supply is the root for change in all other variables in the economy, okay, and by changing the money supply, we can have effect or impact on all other variables in the economy. Restricting the money supply leads to higher interest rate and reduced investment, which in turn causes a decline in GDP and lower down the inflation. So, if central bank is faced with businesses downturn, it can increase the money supply and lower interest rate to stimulate economic activity. And when there is a inflation in the economy, then normally Reserve Bank go for contractionary policy because they need to reduce the demand from the market, okay, because price is nothing but the interaction between the demand and the supply in the economy. So, if there is a high price, so the purpose is to reduce the demand, and therefore they go for the contractionary policy, whether it is fiscal policy or monetary policy, because the only option there is to reduce the demand. But it has other impact also, because if demand goes down, as we have discussed, that it will also impact the producer side also and the supply side also, and that may affect again on the employment, and that we will discuss in the Phillips curve in the future sessions, and which we will see like how the control of inflation will lead to increase in the unemployment also in the economy. The next policy or the tool is the stabilization policy. Now, fluctuations in the economy as a whole comes from changes in aggregate supply or aggregate demand. So, economists call exogenous changes in these curves shocks to the economy. A shock that shifts the aggregate demand curve is called a demand shock, and the shock that shifts the aggregate supply curve is the supply shock. And till now in both the policies, whether it is fiscal policy or it's a monetary policy, we were talking more about the demand side economy, okay, because macroeconomics is more about the demand side economy. But tool can also be used as a supply side economy, because suppose for example when there is inflation, if inflation we are ready to control through demand by reducing the demand, simultaneously we can also adopt policy where supply side economy, where we can increase the supply, because it is nothing but the imbalance between the demand and supply. So, if you match supply with demand or you match demand with supply, there are both ways to control inflation in the economy. So, stabilization policy is the policy which try to work on both sides, okay, demand side as well as supply side, and they try to control both shocks, whether it's a demand shock or a supply shock. So, these shocks disrupt economic well-being by pushing out output and employment away from their natural rates. Now, one goal of the model of aggregate supply and aggregate demand is to show how shocks cause economic fluctuations. Another goal is to evaluate how macroeconomic policy responds to these shocks. So, economists use the term stabilization policy to refer to the policy actions aimed at reducing the severity of short-run economic fluctuations, because output and employment fluctuate around their long-run natural rates. Stabilization policy dampens the business cycle by keeping output and employment as close to their natural rates. Now, to summarize the whole tools and the policy, macroeconomic policy, we can say that monetary policy affects the economy first by affecting the interest rate and then by affecting the aggregate demand. An increase in the money supply reduces the interest rate, increasing investment spending and aggregate demand, and thus increasing the equilibrium level of output. As we discussed, like when monetary policy or when RBI decreases the bank rate, the objective, like now if you see the economy and you will find that RBI is trying to reduce the CRR rate, they are trying to reduce the bank rate, because their objective here is the growth of the economy. They want to create demand, they want people to take loans, so that demand increases, people will spend more, and that will be a motivation for the investor to invest more in the economy, because the primary objective at present is to increase the growth rate of the economy. Now, fiscal expansion, except in extreme circumstances, leads to an income expansion. However, the rise in interest rate that comes about through the increase in money demand caused by higher income dampens the expansion. So, in short, you can say that both the policies are effective, fiscal policy as well as monetary policy. We cannot say that one policy is more effective, the other policy is not more effective, but it depends upon the economic circumstances, the situation in the economy, and sometimes monetary fiscal policy mix also need arises, because expansionary monetary policy reduces the interest rate while expansionary fiscal policy increases the interest rate. Okay, so accordingly expansionary fiscal policy increases output while reducing the level of investment, and expansionary monetary policy increases the output and the level of investment. So sometimes only monetary policy or only fiscal policy may not help to cure the crisis in the economy, and we have to go for a policy mix. So thank you so much for your patience hearing, and we will be discussing more in the later sessions about monetary policy and fiscal policy. Thank you.